Hello, everybody. My name is Jason Lamb from IP Investment Management. IP Investment Management is a proud member of the British Chamber, and I'm responsible for investor relations and business development here in Singapore. I'm also a member of the Built Environment Business Committee at the British Chamber. The Built Environment Committee aims to provide a forum for member-to-member communications to build relationships with, provide inspiration, encouragement, and support to members within the sector, to promote the built environment sector and opportunities for member companies through education, best practice, and awareness of our opportunities, and to encourage diversity and gender equality within the committee and the sector as a whole. A warm welcome to our live audience for today's webinar, Learn and Invest in UK Residential Property post-COVID-19. A huge thank you to our event partners, Macgregor Property, for supporting this important topic today. As a new member of the Chamber, it's wonderful to see you sharing your insights and knowledge with the Chamber network. From a housekeeping perspective, please post your questions into the Q&A facility on the Zoom toolbar below throughout today's webinar, which we'll address as we move through the session. So to introduce our speakers today, firstly, Michael Hodgson from Macgregor Property. Michael has a background in estate agency, having previously ran the Strutt Park and Edinburgh residential team before branching out and starting Macgregor. Rory Gammell previously worked for JLL in Hong Kong and San Francisco for 8 years before coming back to Scotland to work with Michael at Macgregor and also start a whiskey company, Wee Smoky, which we won't be covering today, but look forward to hearing about that another time. Sophie Brown from Gaba Principal. Sophie trained as a chartered accountant with PwC in London over 20 years ago before moving on to focus on mergers and acquisitions and debt structuring. She is now permanently based in Singapore and focused on arranging financing for all sizes of residential, commercial, and alternative real estate assets. Sean Adams from Arc&Co. Sean has 25 years experience in property debt and specializes in international mortgages and mortgages for foreign residents purchasing property in the UK. Welcome to the four of you, and I look forward to an interactive and engaging webinar with you today. Today's webinar is to hopefully provide some insights into the UK residential market and to cover a theme of why, where, and how to invest in the UK. So to kick off with today, first question will be for Michael. But before the first question, Michael, can you elaborate a bit more on Macgregor Property and give an overview of what you and Rory do?
Sure. Well, firstly, hi everyone, and thanks to the British Chamber for hosting us today and for Jason for moderating this webinar. So, who are we? Macgregor is an Edinburgh-based estate agency, and we're focused on selling only the best-in-class property. That's both the owners and investors. So these properties we tend to sell are off-plan, and they should offer long-term income as well as capital growth. Let's go to the next slide. So we specialize in three main types of property. The first are luxury new build homes. These are prime city centre locations. Second are refurbished Georgian and Victorian properties. These tend to be in the West End and the New Town of Edinburgh, and they're characterised by beautiful high ceilings, ornate cornicing, and they often come with off-street parking. And then finally, whole block opportunities. These are often completely off-market, but the starting price for those is about 2.8 million for something like a small block of 9 apartments in the centre of Edinburgh, for example. If you're interested in these, please get in touch because they tend not to be on the website.
Okay, good. Sounds like you've got a great business model, and Edinburgh is where you're based, and I know you've got an example that you're going to share with us a bit later. So look forward to hearing about that. But before getting into the details, Michael, maybe just a step back and back to basics. And can you actually, Rory, if you could help us with this question, just give us some advantages in investing into property and why it's a great real estate investment.
Sure, thanks, Jason. So I'm conscious this audience is likely to be quite experienced in real estate, but to recap on the advantages of investing in residential property. Firstly, it's an excellent store of wealth, of course. Our properties typically offer a net income of around 4.5%, and on average, you will see capital growth of around 3% per year. This year's been unusual. We've seen 8 to 10% growth in Edinburgh, which is pretty staggering, and that reflects the limited supply and increased demand that we're seeing here. Property is an inflation-linked asset, and this is becoming increasingly attractive as a hedge while quantitative easing is happening all over the world as governments fight the pandemic. And then finally, leverage. So as an investor, you can borrow up to 75% of the value of the asset, which can, of course, magnify your returns.
And the last point there, you're saying, yeah, you borrow up to 75%. We'll get into that with Sean a little bit later. But I think, property, bricks and mortar, there's always that intrinsic value through the actual physical asset, the ground, and always a great asset to add to one's investment portfolio. Just then, maybe let's just come back to current environment. Last 12 months has been quite an interesting time, and a pandemic that this generation certainly hasn't seen. Can you give us just a sense of what the current market is looking like? And I think typically property and the property cycle follows the economic cycle, but it's not necessarily the case here. Can you maybe just elaborate on that and give our listeners a sense of the current market?
Sure. So throughout this seminar, Michael and I will go through a number of different graphs comparing different cities and their performance during the last year or 3 years. But broadly, despite the kind of relatively uncertain world, the outlook is pretty positive for UK residential property. And this is really underpinned by the supply issue. So there aren't enough houses being built in the UK, and this supply shortage is keeping the prices high. Over the past 30 years, there's been a trend towards urbanisation. Last year was obviously unusual, showing increased demand for rural property with the work from home environment. But we expect to see continued demand for urban centres as the world normalises, and particularly those with excellent quality of life and good transport links, like Edinburgh, where we are. Increasingly, people are renting now in their 20s and into their 30s. So this offers them more flexibility when they move jobs, but it's really due to affordability. Houses are out of reach for many, so many of them are renting. And this, of course, gives a more stable, consistent yield for investors.
So disconnect in terms of residential property, the residential property cycle versus the economic cycle is what we've seen. So, and I read an article about this. So it's certainly an interesting time, but an exciting time and an opportunistic time for residential real estate. So just then, thanks, Rory. I'll come to Michael now, and I think if Michael, you can, been the Northern Powerhouse, the government has called it, which has really been a drive to expand the infrastructure spend outside of London into other parts of the UK. We've seen the Crossrail in London, we've seen the high-speed rail coming. Where are the opportunities that we've seen in the UK? Can you maybe just elaborate on some of those besides London? I know London's always a prime asset to invest into, but we've seen other opportunities because of the factors that I've just mentioned. Maybe you can just elaborate a little bit on that.
Sure. So we're going to look at the performance of the 5 main UK city markets. So these are highlighted in the slide: London, Edinburgh, Manchester, Birmingham, and Bristol. We're going to look at how these have performed over the past year, during which we've been affected by the coronavirus pandemic, and also historically. We're then going to look at where we then recommend for investment in the future and key trends that are influencing that. So on to the next slide, please. So just to run.
I see Liverpool's not in there. Is that anything to do with their football performance? Sorry.
Yeah.
No, carry on.
Maybe we should include Liverpool next time. So so each of these 5 cities we're going to cover in the next few slides. So just to run you through this graph, so the green bars show the average price in each of these 5 cities, while the blue dots show the average gross yield in each of these 5 cities. So this shows quite clearly, I think, that London has the highest average sale price. I don't think that will come as much of a surprise to anyone, just under £500,000. It's almost double what you'd pay in the sort of northern regions of Manchester, Edinburgh and Birmingham. And then if you look at the yields, you're again seeing a better gross average yield in these northern cities, so 5.1 Manchester, Edinburgh 4.9, and then down to London 4%. So as an investor interested in income, I think this graph shows not only do you get a higher yield in these northern cities, but you also have a lower entry price.
Michael, can I chip in and just quickly say that the funding markets are reflecting that as well. So during the pandemic, one area that didn't seem to be affected at all was development funding for residential projects. And the focus has been predominantly outside of London, because that's where the demand and the yield is, and it absolutely reflects the graph that you've just put up there. Yeah, over the last year, that's, like I say, the one area that has really been booming despite all the restrictions.
That's really interesting. Moving on to the next.
The capital growth, yeah. How's capital growth fared?
So capital growth, again, just running through same 5 cities we're looking at. The green bar chart here shows 3 years. And here I think it vividly illustrates the performance of these northern cities that we focused on the last slide. So Manchester, Edinburgh, Birmingham really leading the way here. So Manchester 15% growth in the last 3 years, Edinburgh 13%, Birmingham just under 12%. Really strong growth. If you look at Bristol, 0 growth over the last 3 years, London just shy of 2%. So if you'd invested in London property 3 years ago, you would see a pretty negligible return. Manchester, Edinburgh, Birmingham, quite a strong return.
Yeah.
The blue. Sorry?
That's supply demand. Is that just driven by supply demand, really? Yeah.
Exactly right. Yeah. So we're seeing one of the big trends that we're seeing at the moment is people moving out of London. So it's increasingly unaffordable for lots and lots of buyers. And these buyers, they can simply afford much more property in Manchester, Edinburgh, Birmingham. So it's not just driven by investors. There are investors buying as well, but it's actually where people want to live.
No, yeah. And obviously the work from home concept is supporting that.
Exactly. Yeah, exactly that.
Yeah, interesting. I mean, I've got a client that works in London and lives in Newcastle. So he's now given up what he lives in London, and he lives in Newcastle now. So I mean, it's certainly a big trend.
Definitely, I think the point that this bar chart shows to me quite clearly is that historically, when we spoke to investors, they knew that when they purchased in London, they would get a low yield. But what they always said was, don't worry, we're going to get a higher capital growth and that will make up for it. I think what these last 2 slides have shown is, not only are you getting a poor yield, which I think everyone knew in London, but you're also not getting the capital growth that I think investors probably hoped for.
Yeah, no, makes sense. Okay. Thanks for that. I think Rory, maybe just to come to you. I mean, and we touched on this in terms of more renters. what is happening on the rental income growth side? You know, how's that performing, and are we seeing growth in rentals?
Thanks, Jason. So if we go to the next slide, please, Helen, I'll talk around this. So there's quite a lot going on this slide, so I'll try and simplify it as best I can. So in blue, you've got the average annual rental performance over the past year. So the blue is what happened in the pandemic in 2020. And in green, you've got the average rental performance over the past 3 years by city. So starting with 3 years, the green, you'll note that all of them are positive, except for London, which in fact showed a negative rental growth trend prior to COVID. When the pandemic hit, so we're now looking at blue, short-term lets, for example, Airbnb properties, came back to the long-term market. So suddenly there was a massive increase in supply on the long-term market, and because some of these markets all fared slightly differently depending on how many short-term properties they had that switched to long-term. So Edinburgh has many short-term rental properties, and because of that, rents declined over the short term. This is expected to rise again as the world normalises. You'll note that London, in particular, rents suffered enormously over the lockdown period. So that's the big blue.
Okay.
But one positive here, I suppose, is that London is becoming more affordable for younger renters. And we're looking at, they're looking at up to 30% cuts in rents in Soho for a 2-bedroom flat, I've recently heard. So this is obviously not so good for investors in London who are taking that 30% hit on their income.
Yeah, no, absolutely. And what is happening on the sales side? Are we seeing activity from sales across these cities? The proof's in the pudding. So I think that graph does show that, but there's a little dip at the end there. Maybe you can just chat about that, and why was that, and is it continuing downward, or are we going to see it continue up?
Sure. So this graph, as you say, shows the volume of transactions by city. So each colour shows a different UK city over the course of 2020. Perhaps unsurprisingly, all the cities showed a sharp dip after lockdown in March, and at that point it was physically impossible to buy property under lockdown. Agents couldn't even let them in the door. So that wasn't due to any decrease in demand. And once agents were able to adapt to virtual sales and viewings, volumes increased, as you can see, throughout the year. And Edinburgh in green has come out the strongest of all of these cities. We've in fact seen record demand for Edinburgh properties in the city centre. As for your question about things tapering off, we're not really seeing things cooling off at all here.
So have you got sight of what's happened in 2021? I mean, we're through the first quarter. You're saying that it's still sales are still coming through?
I'll let Michael answer that one in a bit more detail.
Yeah, I mean,
okay.
I think this graph shows that there was just so much pent-up demand built up throughout the lockdown, and so the tapering off was just a natural release from all the pent-up demand. These are the most up-to-date figures that we could get, so they're from the Land Registry. They run about a quarter behind, but from sort of on-the-ground sales, I mean, it's been pretty mad, and and that's not just in Edinburgh, that's across all the regions with the exception of London.
Yeah, and I suppose if you take, I don't know if it's you take the GDP growth and you put that on there, I suppose they don't align, although this is volume. Maybe can you cover, what sort of prices are they being sold at? I mean, are they being, is there been a drop in valuation?
So yeah, this slide I think answers that question, Jason. I mean, can you spot where the pandemic hit in terms of sales prices? April last year. Not really is the answer at all. I mean, you really can't see it. So you might expect some volatility or discounting. Sorry?
It's a flat line.
Right. Every every city's showed a more or less flat but steadily upright, steadily rising trend. Yeah, they've all been pretty resilient. So I suppose while we have seen dips in the rental market that we talked about earlier, we haven't seen them reflected in sales prices.
Okay, so just a question then on rental collections. You know, from an investor's perspective, I think that's one of the things, you know, that you want to, you know, sleep at night. You want to know that you've got a tenant in there that's paying your mortgage. So, you know, maybe just can you elaborate? Michael touched on it a bit earlier, that there's been a 30% drop in rentals in London. But what has the collection been like? You know, in comparison to, I know, retail, and I read that retail and commercial, you know, they were only collecting 40 to 50% rentals. How's residential stood up from a collection perspective?
That's exactly right, Jason. So the answer is it varies massively by asset class. So while, you know, offices, or particularly, you know, retail was down more than 50% from what I understand in terms of rent collection. But what this graph here shows, so this is all residential rent collection in this graph during the course of last year. And it never dipped below 92% rent collection, averaging 95% over the year. So what it really shows is that residential is very resilient and steadily yielding as an investment compared to other asset classes.
Yeah, no, I mean, that's, you know, we own a few residential assets, so we've certainly seen that too. So, you know, people need places to live, so rental gets paid. And I think obviously the fiscal support and the support from the banks ultimately has helped landlords in getting rentals paid, which is positive. Michael, just outside of the numbers and talking about collections and growth, etc., in income and sales increasing towards the end of 2020 and now continuing, what are some of the trends that we've seen and benefits to investing in the UK? Almost sweeteners. Why would it be a good time to invest in the UK? Can you share some insights and thoughts on that?
Yeah, sure. So we've there's been a few trends that have been driving the market at the moment, and they tend to differ between England and Scotland. You know, Scotland and England have completely separate laws, especially tax raising powers. So the first, I suppose, big driver in the market in England has been the stamp duty holiday. So the stamp duty holiday in England was due to end on the 1st of April. That's for stamp duty up to £500,000. It represents about a £15,000 saving on any property purchased. That's now been extended by the government to the 30th of June 2021. I mean, it's really led to a bit of a frenzy across England. It's sort of adding stimulus to an already very stimulated market. I think what we're likely to see when this stamp duty holiday comes to an end, that transactions will be much reduced. So anyone who is looking at buying a property this year will almost certainly have bought it in the first half of this year in England to take advantage of the stamp duty holiday.
Okay.
The point in Scotland, the picture is slightly different. So there was a stamp duty holiday. It was only up to £250,000 and represented about a £2,500 saving on a property. That ended on the 1st of April. And despite that ending, the market in Edinburgh, as we saw in terms of volumes, has actually risen far and above any of the English cities that we're comparing against. And I think that shows that it's not being artificially inflated by, you know, stamp duty holidays or stimulus. There is real underlying demand for moving to Edinburgh, and that's due to the sort of lifestyle choices that we'll come on to in a second.
Okay.
The other trend that we're seeing, sorry, if we just go back up a slide. So the other,
Yeah, at interest rates, yeah.
yeah, the other is the non-resident tax. So this has just been introduced. This is introduced on the 1st of April this year and applies to anyone purchasing from overseas, regardless of the entity, if it's a limited company you want to purchase in or in your own private name. And I think this shows the direction of travel. So while this has just been introduced in England, 2% additional, it's not been announced in Scotland yet. I'd say it almost certainly will. The Scottish government, like the English government, will need to raise taxes on a range of issues, and any extra tax raising powers that they can implement, they almost certainly will. So I think it just shows that, while it hasn't been introduced yet, it might represent a buying opportunity in Scotland before it's introduced for an overseas buyer. The third point here is on interest rates. So we all know that interest rates are, a main driver of property prices because most people purchase with debt. And they're currently at record lows. Bank of England base rate at 0.1%. Oxford Economics here, they're an independent forecaster, they forecast interest rates to remain low till 2025. So as long as they remain low, there'll be a real interest in sort of tangible assets like real estate.
Okay, inflation?
Yeah, so in
inflation.
Yeah, well, I mean, inflation is unfortunately a result of all the quantitative easing we've seen around the world as governments having to pay for all the debt that they've taken on to pay for the lockdowns and coronavirus. So what we're saying here is, a property represents a hedge against inflation. So your income from the property will go up in tune with inflation. So that acts as a good hedge. And also, if you ever come to sell, hopefully there'll be some capital appreciation at the end as well. Where, we say roughly 3% a year for the Edinburgh market. That's what it has been for the last 10 years or so. The final point here on trends is just a fundamental. Rory actually touched on it earlier, but supply and demand. The UK just isn't building enough homes. So as long as this trend continues, we think there'll be strong demand for residential real estate in the UK.
Yeah, no, I think supply demand is key, and I think there's a stat that I read somewhere that on average 200 homes are needed per annum in the UK, and they haven't hit that mark since the 90s. So that there's a continual lag and shortage. Thanks, Michael. I think welcome back, Sophie and Sean. Just to switch the conversation to yourselves. Sophie, new member of the British Chamber, can you provide a quick overview of Gaba Principle and your collaboration with Sean and Arc&Co?
Yeah, of course. Thank you, Jason. So as Michael and Rory have talked about, the majority of people purchasing property purchase with finance, with a mortgage, because even if you have the cash to buy the property outright, that means your equity can go further, and we have an example to show how that means your overall income and assets will be enhanced if you go that route. There are a lot of options available in terms of financing, and therefore getting the right person to help you get the right financing is the key step, because that will really enhance the performance of your overall assets. There's numerous factors to take into account when finding the best mortgage for you, and those considerations are increased when you're either an expat buying into the UK or indeed not from the UK yourself. So that's where Sean and I can really help you. I'm based in Singapore full-time. I don't know when I'll ever get back to the UK as it stands. So I'm based here, and I can meet you in person and go through what your requirements are, because ultimately the best financing is about what your requirements are. Is it the maximum loan to value that's important to you? Is it the lowest rate but maybe slightly less debt? Whatever it is, I can meet you, really understand what your requirements are, and then Sean and his team in London have excellent access to the whole of the market products, and products that not every broker has access to because of their their connections there, and they're also FCA regulated. So we work seamlessly as a team to provide the best service to you, because that's what matters to us, and that is what will give you the best performance on your investment property. So if we flick over to the next slide, then Sean can take you through the key criteria to consider when looking at mortgages for overseas buyers.
Thanks, Sophie.
Thank
I
you.
think one of the biggest is finding the finance and to be able to know that you can purchase, you know, your investment property. So great that you're here in Singapore and that you're able to meet face to face to help potential investors. Sean, maybe you can give us a sense of the current market right now, and you know, is it easy to find debt finance, to find a mortgage? Are banks lending, or are there alternate sources of lenders out there? Maybe just give us a snapshot of how the market is at the moment.
Sure, thanks, Jason. I think traditionally it's been quite difficult for foreign nationals and expats to obtain mortgages in the UK. But over the last sort of 18 months, 2 years, we've seen a marked increase in the number of lenders in this space. I think that might partly be due to the expansion of the British national overseas visas that for residents of Hong Kong. And also the promotion of various golden visa and investment visa programs. But lenders have reacted to the fact that there is increased demand from that part of the world. And in fact, some banks have set up teams that are especially focused and pointed towards Southeast Asia. So they're able to understand the type of clients, the type of paperwork, and the processes. And so, you know, in summary, there's an increasing number of lending options available to non-residents, expats, and especially those coming from the Southeast Asian part of the world.
Okay, good. And what sort of interest rates? I mean, we know that base rates are at a record low, but what sort of interest rates are we seeing, and loan to value? Maybe you can answer that as a dual. What sort of loan to values and interest rates are we seeing in the market?
Sure. Well, yeah, I mean, like you say, we're benefiting from historically low interest rates at the moment. And I think it also increasing lenders coming to the market for this segment, you know, non-residents, expats, is helping drive prices down, and the market is becoming more competitive. Typically, as a foreign resident, you'd be looking at a rough interest rate of around 3% at the moment. Although, like I said, increasing that down, we're seeing lenders move into the twos. We've got rates at the moment for borrowers at 2.5%, and I'm informed that there's going to be some products coming to the market that have even lower rates in the next few months. I think to achieve the best terms and the best rates, it does help to have a larger deposit. So you can borrow up to 75%. It's increasingly common. But if you were looking to borrow 60 or 65%, then you might get a slightly better rate. I think interestingly in the UK market, in some instances, the bigger the loan amount, actually, the better the rate you can get. So in some instances, borrowing 300,000, you'll obtain a better interest rate than if you were borrowing, say, 150,000. And then I'd also say that with some lenders, if you're able to repay the capital over the term of the loan, then you might get a keener rate. That said, nearly all lenders will offer you the ability to just pay the interest to help maximize your investment, you know, over the course of the loan. So yeah,
and that's 20, 30-year terms. What sort of terms?
Yeah, I mean, typically in the UK, you'd borrow over a 20 or 25 year term. I mean, we have a very fluid lending market, so it's quite common here to have a loan for 20, 25 years, but then have either a fixed rate or an incentivized rate for the first 2, 3, 5 years. And then the costs of refinancing are relatively cheap here in the UK. In some cases, lenders will pay your legal and valuation fees. So, you know, you're always able to, you know, hopefully via a mortgage broker, negotiate your way onto, you know, in increasingly good terms as you go through the course of the loan. But yeah, typically you're looking at a 20-25 year term.
It's a borrower's market at the moment. And you know, who'd have thought after what we saw post GFC and then now going through this pandemic. So interesting.
Yeah.
Thanks for that. I think just another question, Sean, in terms of ownership, do people buy in their own name or through limited companies?
Well, recent tax changes, which Michael alluded to in the UK, have actually meant it's much more tax efficient for some people to buy through limited companies. I mean, I should say always that really it'll depend on your personal circumstances, and you should always take tax advice. But this is the direction of travel in the UK for investment property. More and more lenders are coming to the market able to lend into limited company structures, and I think over the course of time we will see that there'll be more lenders lending into limited companies than into personal names. And for foreign investors, other than potential tax advantages, I think there's also some inheritance benefits to owning through a limited company. And I think just to reflect that point, on the final slide, I allude to the fact that we've been informed of one product coming to the market, which is going to be an extremely competitive rate only for buyers who are investing in property through limited companies.
Can we see that next slide? Maybe you've got an example there. Is you're talking about this?
Yeah, just at the bottom where we've alluded to the fact that you know, for properties owned through limited companies, you'll be able to get a 75% loan to value mortgage at a rate of 2.1%. You know, which is about as keen a rate as I've seen for this segment in the market ever, really.
So I mean, these slides will be available for everyone that did register, so we can send that through. But I think, and maybe they can study this in more detail, but maybe just to highlight there, I think what is just showing the return on investment if you borrow and if you don't. So with or without mortgage, you can see how much your return on investment, you know, is almost more than, or it is more than double. So I think just in terms of time, I want to just crack on a bit, because I know Michael's got an exciting a case study that he wants to share with us. So Michael, just back to you. Thank you, Sean. With regards to your case study, I know you're going to share it's Edinburgh. But before getting into the case study, why Edinburgh? I mean, it's famous for a few things, but there it is there. I don't see whiskey or golf on there, but tell us a little bit more about Edinburgh.
Sure. So we're based in Edinburgh, but I think what we've seen is people moving to Edinburgh for the reasons I'm sort of about to outline. So I think the first reason is the excellent quality of life. So, you know, we have a disproportionate number of fantastic restaurants, cafes, bars, all within walking distance of the centre of town. I think that's a really key point. So over the last few years, city planners have increasingly been talking about the 15-minute sort of city, where your work, your social, and your home are all within 15 minutes walk of each other. Now, Edinburgh is about 200 years ahead of the curve. Everything here is within 50 minutes walk of each other. And I think with the increasing focus on quality of life, partly as a result of the pandemic and people spending more time in their homes, there's been an increasing focus on cities that offer that everything within a 15-minute sphere, which Edinburgh has.
Fantastic.
Yeah,
and it's how far are the golf courses?
I mean, we are spoilt for choice in golf. So, I mean, they really are. From where I live in the centre of town, I probably have 3 or 4 within 10 minutes
Yeah.
drive. And then if you're willing to drive for half an hour, you've probably got about 30 to pick from.
Yeah, no, Edinburgh is an amazing city, and Scotland as a whole, just I mean, whiskey, golf, and fly fishing. What more do you want in life? Okay, do you want to run us through, or do you want to go through some of those other points there, just conscious of time, and then you can get into your case study. I want to give us about 10 minutes for questions.
Sure.
So if you can just go through those last few, great points about Edinburgh, and then we can get into your case study.
Sure, I'll run through them just really quickly. So Edinburgh, beautiful World Heritage Site, the New Town and Old Town, lots of beautiful buildings. I think the main point probably for overseas investors are the excellent universities and schools. So Edinburgh University, probably most famous top 20 university in the world, as last voted for by the Sunday Times. And then schools, excellent schools. So Betty's College, probably most famous for as a boarding school, but also Edinburgh Academy, Mary Erskine's, these other day schools, which are excellent and attract people from all over the world. We've also got the biggest arts festival of the world, which takes over the city during August. If any of you haven't been to Edinburgh over August, I really recommend it. It's a great time to be here, and the city really comes alive.
It's on the to-do list.
Yeah, it's great fun. And then there's also very well connected. So international airport within 20 minutes, and obviously rail to the rest of the UK. I'll let Rory take on. We're going to run through a case study just quickly,
Okay.
and I'll let Rory take.
Thanks, Michael. Rory, if you can just go through that your case study with us, and share with the listeners what you have up your sleeve.
Sure, thanks, Jason. So here's a development that we're marketing at the moment, which is due to complete in Q3. It's developed by Artisan, who are one of the UK's leading real estate developers. They build a very high quality product that's designed to kind of stand the test of time and last for years. It's not dissimilar to Swire in Asia, I would say, in terms of quality. They don't cut any corners, certainly. And there aren't many large developments of this quality in Edinburgh, I would say. So we're thrilled to be involved with the project. The location is, for those familiar with Edinburgh, it's just on the northeast corner of the new town, on the edge of the water of Leith. So it's about a 15 minutes walk to the city centre and 5 minutes from the Royal Botanic Gardens. So definitely a desirable area to live. Moving on, I think we're on the next slide. So this shows you the kitchen from the show apartment. Everything is plug and play essentially. So you've got all the high-end fittings there throughout, including engineered oak wood flooring, very high-end bathrooms tiled throughout, which we'll show you in a minute. If we just jump onto the next slide, you can see wardrobes are all fitted, carpets are all included. So the idea is that as an investor, there's very little work for you to do before you can rent it out. And then there's a furniture pack available for purchase in addition. So yeah, it's very much plug and play. Here's the bathroom, all very high end, no corners cut at all, as I say. Just to walk you through quickly through pricing, apartments range from £313,000 to £350,000. So in Singapore dollars, that is 575,000 to 645,000 Singapore dollars. And on rents, you expect to get back from that, depending on the size of the apartment you go for. We're looking at between £1,300 and £1,500 a month, which is 2,400 to 2,800 Singapore dollars per month. And that's overall, you're looking at a net return of around 4.5%. That's after paying for your letting and management fees and the factoring fees to run the building. Okay. Now, just to race you through an example of how a purchase would look, we can go into details more specifically if you're interested in this after this. But I think the key message here is that the cash required to invest is around £98,000, which is 180,000 Singapore dollars. Yeah, we can go through all this in more detail as and when you're interested.
Great. I think maybe if you can just share a comparison between this and one of the other UK cities that you spoke of before. I think, Michael, you were going to do a comparison for us. Can you elaborate on that and just show us, you know, the value for money between Edinburgh and London?
Sure. So this is the final slide we're going to run through. This just highlights the two live real examples. So in London, PCL is Prime Central London. This is an example of a property for sale in Paddington at the moment. We've chosen Paddington because it's the most affordable or best value area in Prime Central London. And then Edinburgh, we've just used the example that Rory's run through Cannon Mills Garden just a second ago in that case study. So the point here is both these cities show 17 or forecast to show 17.1% growth over the next 5 years. That's independent research by JLL, the property consultancy. The difference here, I think, is shown in the yield. So yes, you're likely to get the same return over the next 5 years, according to JLL. The net yield in London, more likely to be about 3%, as opposed to in Edinburgh, closer to 4.5%. The other difference is in the entry point. So £525,000, that would actually only buy you a 1-bedroom flat. As opposed to in Edinburgh, much more affordable. This development here, 313,000, and that gets you a 2-bedroom apartment. So I think the message here is pretty compelling. So buying in Edinburgh at this development, so Cannon Mills Garden, for example, you're getting the same capital growth as London, forecast by JLL, but with increased yield at a reduced price.
Yeah, and I think it's good value for money. You can almost buy 2 properties in Edinburgh versus what you can get in London. And I think also the component there I like is the 2-bed versus the 1-bed. And, you know, 2 beds are a lot more sellable than a 1-bed, and there's a lot more demand for 2 beds than 1 bed. So it looks like a great investment. Thanks for that. I think that comes to the end of our slides and our discussion. Let's have a look at the Q&A and see what's come through from the audience. And please do keep your questions coming through. We've got about 10 minutes before we do a close. So please send through any questions that you have for us to answer. So the first question: how will Scottish independence affect the market in Scotland? So I think that's for Michael and Rory. If you could give us an answer on that. How will Scottish independence affect the market in Scotland?
Sure, I can take that one. So independence, for anyone that's following the newspapers at the moment, it's everyone's talking about it. It's all over the news, and to be honest, it hasn't really been out of the news since the last referendum in 2014. We've been chatting to lots of people who are currently buying properties, and it doesn't really seem to be on people's minds. For a start, we've seen huge demand for Edinburgh for the reasons that I've outlined above. So people want to be here for, you know, quality of life, work from home. And I think what we're seeing is, even if it does happen, I mean, all the polls are saying it's 50-50. So it might happen, it might not. But even if it does happen, people don't seem to be too worried about it. And, you know, the lifestyle is still going to be great here, and people still want to be based here. So I think, I mean, who knows what it will mean, or sort of if it even happens, but certainly buyers on the ground we're talking to are pretty optimistic, and they don't seem to be too worried.
Yeah, I think just to add to that, our company does student housing, and we've got an asset in Stirling. And just from a student perspective, you know, we don't see that there's going to be a drop in students coming to Scotland for you know, Brexit or joining the EU, etc. So I think you know, it's kind of just a bit of noise, I think, at the moment, and it's not really impacting underlying fundamentals. Great, thanks for that. Another one here with Brexit. Let's keep on the Brexit scene. Are we seeing an exodus of corporates and renters to other European cities with potential relocation, I suppose, of corporates? And is this having an impact on the market?
I think the answer is probably similar to what you just said, Jason, in that we're not really seeing an impact, despite all the chatter you see on the news about this topic. We've just showed you all the statistics, and they're all show kind of steady rises in prices. So we're not really seeing it impact things. I don't think there have been any major corporate relocations to speak of just yet, but there's certainly talk of it, and maybe you could speak a bit about it. You'll no doubt have been looking at the same thing.
Yeah, and I think we touched on this in previous conversation. I think there's such a shortage of accommodation in the UK. So if there was an exodus, the supply demand imbalance will easily be catered for.
Exactly.
Another one here on interest rates. So you touched on this, Sean. Fixed interest rates. Would it be advisable to fix interest rates in the current environment, given where base rates are?
Yeah, well, I mean, there's definitely some logic to that. We're at historic lows, so interest rates aren't going to get any lower. I think there is an argument also for, with an investment property, knowing what your fixed outgoings are going to be every month vis-a-vis your rental income, obviously carries some advantages and helps de-risk any investment. Whether now is exactly the right time to choose a fixed interest rate is actually down to your own personal opinion and how you feel comfortable with regards to interest rates. And I say that because you can get a very competitive 2-year variable rate that will be maybe 0.5% cheaper than a fixed rate. So the question is, in 2 years' time, when you look to refinance onto what might potentially be a fixed rate, then are they going to be any higher? I think the likelihood is that fixed rates will be higher in a couple of years, and I think now is an attractive time to obtain a fixed rate. But you will pay a slight premium for it.
What sort of premium? Do you know offhand?
Yeah. So well, it varies according to the loan to value you're borrowing at. On average, you're paying about a 0.5% premium for a fixed rate. And the longer the term of the fixed rate, the higher the premium goes up. So, for instance, if you're looking to get a 3-year or a 5-year fixed rate, then the premium you'll pay will be exacerbated. So a 5-year fixed rate will probably be another % and a bit higher.
Okay, so there is a correlation. Okay, a question for Rory and Michael. As an investor, can Macgregor help source and find tenants? Is this part of the service that you offer?
Yes, we can. We've got a letting team run by colleague Mike, who's not with us just now, but he's an excellent, experienced team leader, and he looks after all the investors and finds tenants and runs the maintenance team as well. Okay,
excellent. And do you, just as a matter of interest, are you able to help with, if an investor at some stage wants to sell their property, are you able to help with that too?
Of course, yeah.
Okay. All right. So I think let me just check if there's any more questions. Someone's just saying goodbye. How easy and business friendly is it for a foreigner not resident in the UK to access mortgage offering UK banks remotely, given COVID and travel restrictions? How can you facilitate the paperwork? So, thanks, Alberto.
Yeah, well, I mean, I think actually, COVID hasn't really affected that, because traditionally dealing with non-residents has involved a lot of remote dealing anyway. I think lenders, as I mentioned earlier, are well set up now to deal with A, people remotely, and B, people from this part of the world. So it's getting easier, and like I say, the fact that banks are actively seeking out clients with these circumstances bodes well for the future.
Yeah, and I mean, that's what you do. You help knock down those doors and help investors find that mortgage finance and deal with the paperwork, etc.
Absolutely. Yeah, indeed.
Yeah.
Indeed.
Okay. A second question from Alberto. Do you expect any imminent taxation changes for real estate property investments in the UK? Inheritance, rental income, other duties, etc. So that's a tax question. Anyone on that?
The only thing I would say on that is what I sort of touched on earlier. So from the 1st of April, the English government introduced a surcharge on overseas investors, and so that's a 2% surcharge on overseas investments. So investors buying property in England, I imagine that is likely to be introduced in Scotland as well. Other than that, I don't think I can forecast much more.
Yeah. Okay. Yeah, not an easy one on the tax side. So I think that comes to the end. That was a final question. Thank you, Alberto. If there are any other questions, then this presentation will be available, and we can put you in touch with Michael, with Rory, Sophie, and Sean. So thank you everybody on the panel today for engaging and informative session. I've thoroughly enjoyed moderating this. So thank you for your insights. Thank you to the audience for joining us. A big final thanks to Macgregor Property for your support of today's webinar. Helen, thank you for all the behind the scenes work. It's been fantastic, and you've been a star. I'd like to highlight a few up and coming webinars in the Chamber's calendar, which you can see on your screen now. So please join us on the 20th of May for the BritCham Annual General Meeting 2021, which has been held virtually from 6 o'clock on the 20th of May. And finally, you'll receive a feedback form. Please do take a moment to complete this and share your thoughts on today's webinar, as well as future topics you would like to see covered. So many thanks once again, and we hope to see you on another Chamber event soon. So thanks everybody, and thanks to the guys in the UK and Sophie here in Singapore. We'll see you soon. Thanks everybody.
Thanks, Jason.
Thanks, Jason.
Thank you.
Pleasure.